So this week we've had a good week for equity markets, particularly emerging market equities, and that's been helped by the Chinese export numbers, which were up 11.3% year on year in June against 8.7% in May. So that's an acceleration. That's helped materials and energy in developed markets in terms of the sectors. Emerging markets have also been helped by a softer dollar. That's been a result of the Fed talking. So we've had Yellen and Brainard talking this week and saying that they felt that inflation was coming in a little bit softer than they had perhaps anticipated. Brainard also said that she doesn't feel that we've got very far to go in terms of reaching the neutral rate for interest rates. So that's the rate at which it's neither restrictive or stimulatory. And here you can see the chart there. The upshot of those two dynamics, was that we saw the yield curve steepen. So at the short end, because interest rates are less likely to go up, we saw short-dated bonds, or the yields on bonds, fall slightly, and at the long end, because we're seeing more sort of growth, global growth, we're seeing that long end go up. So a steeper yield curve is really good for the equity market and signals better conditions for equities. The flip side of that, though, is that if we don't have very far to go to get to that neutral rate, then we're in this lower interest rate environment, and many people feel that this low interest rate environment will extend the business cycle. So if we look at the leading economic indicators, which is this blue line here, it tends to be a really good predictor of negative GDP growth. So when this goes through zero, you get quarters where GDP growth goes to zero. Averagely, we have 22 periods between going from positive to negative on this blue line. And at the moment, we've had 30 quarters of positive LEI. And so that really is pointing to the fact that this low interest rate environment is actually extending that business cycle, which again is good for the equity market. This week we had a TSMC report, and they upgraded their forecast for overall semiconductor growth from 4% to 6% for the year. I think this is important because we're going into a semiconductor super cycle, or we are in one, and that's because of movement into the cloud, mobility and autonomous mobility, Internet of Things, as you can see here, all creating the demand for data use and the demand for silicon to facilitate that. What we're starting to get a better handle on is the actual economic impact of this connected world. So if we're looking at, for example, data analytics, that could produce something like $3 to $5 trillion of value. US retail, 60% increase in net margin is possible because of this more connected, intelligent use of data. Manufacturing, up to a 50% decrease in product development and assembly costs. So you are starting to see perhaps this data revolution is an answer to the productivity conundrum that we've been seeing over the last few years, as productivity hasn't picked up despite a supposedly fairly healthy economic backdrop. Going into next week, we're finally into the quarterly results season in earnest. So there's an awful lot of results coming out. On Tuesday, we've got United Health, Johnson & Johnson, Goldman Sachs, IBM, all really important for Killik stocks. US Bank Core on Wednesday, and ASML, another play on that semiconductor cycle, coming reporting on Wednesday. Thursday, Unilever, Union Pacific, Visa, Microsoft, all reporting. SAP in Europe, and finally Friday we've got Vodafone. So that's it from me. Thanks for listening.